Hello, good evening, everyone, and welcome to another episode of the Property Show Live by Dream Valley Realty. And my name is Sabir Khan. I'm the broker of record at Dream Valley Realty, and I'll be your host this evening as well. As you all know, I really want to thank you all for joining us through Facebook, YouTube, and LinkedIn. And we really appreciate that every week you're joining us and supporting our program. We bring different professionals related to the industry of real estate every week, every different professional to help you and guide you through the experience of real estate journey and advise you how can you make it better journey with all kind of information that we can gather for you to make your decision more informed. As usual, for every week, we have a different topic. So this week we have a topic, we named the topic is mortgage renewal and refinancing, and if you are getting the best deal for it. So for many homeowners, getting a mortgage is one of the biggest financial decisions they will make. But what happens when your mortgage term is coming to an end? Do you simply accept the renewal offer from your current lender, or should you shop around for a better rate? When does refinancing make sense for you? And what should you consider before making a right decision? These are simple questions many homeowners have, but they don't always know where to go and get the clear answer for it. That's why tonight we're going to have a practical conversation about mortgage renewals, refinancing, interest rates, penalties, and the options homeowners should consider before signing their next mortgage term. I'm very pleased to welcome our very special guest this evening, Mr. Harvey, licensed mortgage professional with Mortgage Architects. Let me bring him on the stage. Hi, Harvey. Welcome to the Property Show Live. And I really appreciate you joining us, and we're happy to have you here tonight.
Thank you, Mr. Khan, for having me, and it's truly an honor to be here with you.
Thank you so much. And before we start the show, I would like to ask all our viewers, please, if you have any questions or any concerns regarding mortgage renewal, financing, or refinancing, please feel free to ask throughout the night, throughout these questions, throughout the comments. Please write in your comments, so let us know. If we have enough time, we'll try our best to answer most of your questions this evening. So without any delay, Harvey, we generally start with the very basic questions to all our guests. We always start just to share with our viewers, how did you, just about yourself, and how did you start this mortgage journey? If you can start from there.
Oh, okay. Okay, so thank you again, Mr. Khan, for having me today, and I really appreciate the opportunity to interact with your followers and your friends who are watching us over different platforms today via social media. How I came into mortgages? Well, it's been a long journey for me. Me and my family, we have an operational business where we used to be mostly into the commercial lending business for motor vehicles back home. And it's after that when I immigrated to Canada, and I tried a little bit of other options, just like everybody does when they come to Canada. But then I found myself home with the mortgage industry itself, because this is what I could relate myself more with. My first love has always been numbers. I was good in maths, but I was very good in numbers in overall. And the mortgages in itself in Canada, it's not just about numbers, it's also about emotions. When someone's buying a property, it's just not that a piece of land they're buying emotions along with it. So I wanted to be a part of that journey with the borrowers who are looking to close a deal for themselves or buying an investment property to help them in their old age. You be more involved into the process of everybody. That's what I would say the main motivation was to come into this industry.
So thank you for sharing this with our viewers. And definitely, it comes from your heart to help our people, of course. That's how you start the journey. I appreciate that answer. Harvey, next question I want to ask, for many of our viewers probably would ask this. And if they want to buy a home, and what should they do before they start looking for properties? Because they get confused all the time.
Thank you for this question, Mr. Khan. And this is one suggestion that I always try to give to all my clients who reach out to me. I said, before you fall in love with the house, understand the mortgage. That's probably the most important advice I can give, honestly, because it's very important for us to sit down, with the clients, and so is for the clients to sit down with the mortgage professional even before they start seriously shopping or looking for properties. We want to understand the client's income, their credits, their existing debts, down payment, and all the closing costs that they can arrange, and determine a realistic purchasing price. Because the question shouldn't be what is the maximum mortgage that a client can get. The better question is what mortgage can a client actually comfortably carry while still enjoying their lives. Because it's very important, Mr. Khan. People end up making some decisions just on the basis of, okay, fine, I'm making $100,000. That means I can get a maximum mortgage of $500,000. Well, I should go for it. Should you? These are the things that we sit with the client, we talk. For example, if I was to give you an example, I'll tell you one very recent story. Young couple, beautiful couple. I mean, they are into a relationship. They look forward to getting married right after the closing of the property. They're buying the property together, coming in. Both of them are making decent income, $80,000 each. The husband and wife. They wanted to buy a property for $800,000. Now that's exactly the 5 times, and they're trying to max out. They don't have any liabilities now, right? This is where they think this is the best time for us to buy. We don't have any liabilities. But then I sat with them. I said, I understand you don't have any liabilities now, but we need to plan for the future, because the obligation that you're going to sign for is going to be an obligation for another 25 to 30 years. So do you plan to add any liabilities to yourself? They said, liabilities like what? I said, probably getting a bigger car or something after closing. Or, do you plan to have kids? Because once you have kids, that may be an added, responsibility on you. Because in today's time, you might think, okay, fine, just me and my wife, we could live with that. But once you have kids, once you have, family coming over, once you have your parents coming over, things change. And that's where we have seen families going under stress due to financial.
Mhm.
These are certain things that sometimes people do need to consider. So that's why I always say, Mr. Khan, before you fall in love with the property, with the house, understand the mortgage. It's not always about the rate.
Right.
Rate is a secondary thing. Getting a mortgage approved is one thing. Getting the right mortgage is something completely different.
Correct. So they
This is
have to look at their budget and ratio and everything. So do you suggest they should always talk to an expert before they actually look into? Of course, just to
always, always, always. That's exactly what I mean when I say before you fall in love with the house, understand the mortgage. So you sit with the mortgage professional. You can sit with us. We are available. You can book a call with us. We are available to sit down. Basically do the budget for you guys. Do a plan for you, like what's your plan in the next 5 years. Obviously, because if you're working at $80,000, you might be even seeing some increments down the line, right? Depending
absolutely.
on what job do you get any bonuses, what can you expect from that position? Or if you were to switch, like your idea is just to gain some experience in this job and then probably switch to a higher paying job down the line, what do you
Absolutely.
expect, what do you anticipate? So budget needs to be made.
Right.
And that's where most of these first-time home buyers, Mr. Khan, they lack, and they end up into situations where then they have eventually, because once the financial burden, the stress kicks in the family, then it tears everything apart.
Right. 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 Now, Mr. Dole, so what happens when they decide everything? They say, okay, you know what? We kind of like had a pre-assessment done, and how these lenders looking at them, and how they actually, what are they looking for in this buyers when they're initially getting approval or they're going through the process?
It's very simple, Mr. Khan. And when I say it's very simple, is lenders are usually looking for only 5 C's in an application. Now, that's what I also educate clients and the realtors about it. So, what are these 5 C's? C for Charlie, like, right? So, the 5 C's are, the first C is the credit, how you have managed your debts, how responsible have you been. Sometimes people think that if they have a credit score of 800 Equifax score or TransUnion score, that's the best thing that could happen to them, and they are the most eligible people. But that's the half-baked information. Lenders do look at your history. Lenders look at least 2 years of history. Have you ever missed any payments? Have you ever signed for anybody and that person have failed to make their payments, and has that affected your credit score? How responsible are you with your debts? That's number one. C. Yes, sometimes clients think that our credit score is the best, so we should get a mortgage. It's not just that. Remember, there are 5 C's. First is credit. Second is the capacity. What is the borrower's capacity to support the payments in terms of what income do they make? What kind of income is it? Is it salaried income? Is it hourly income? Is it a contract income, or is it a self-employed income? The
Right.
third C is capacity. How much of a down payment do the borrowers have? What kind of financial resources do they have? Is this been invested into different formats like RRSPs, like TFSA, or do they have their own savings other than the RRSP and TFSAs? Right? Then the fourth is, I would say, is basically collateral, the property that they're looking to buy, the location of the property, what's the condition of the property, the age of the property, and the other aspects of the property. And the last is basically the overall profile, which is the character. So, like, how long has been the borrower been with the same employer? So things like employment stability, credit history, whether the entire application in overall makes sense. There might be scenarios where the 3 C's are perfectly fine, but the fourth and the fifth C doesn't make sense. The lenders can still reject the application. So it's very important to sit with an actual mortgage professional who understands the business and who can guide you before you jump into a ride which could eventually turn into a roller coaster or a very bad ride for you.
Absolutely. So all these 5 C's are you're talking about. So they're all equally important to
Yes.
before the lender can actually qualify them for the mortgage. But
Yes.
as far as the credit score, I know it is one of the very important things that people always look at. Is there a certain score that you can only work with, or because I have seen people has high score but they don't qualify other C's that required? Obviously, I've seen people with 800 score, but it really doesn't matter. And sometimes I see people get qualified with 650 scores, right? So if you can elaborate a little bit more about the credit rating and how does it, because I had people ask me, they came to this country a year ago, but their credit score is excellent, like over 850, but they cannot really qualify. So if you can elaborate a little bit for us, our viewers, that would be great.
Sure. So let's say someone's come to the country a year ago. They have
Mhm.
built up a bureau. They have built up credit ratings. The credit ratings are there, but they don't have the history. Or let's say they don't have the income. Or let's say they don't have, a good property that they're looking to buy. Or they don't have the down payment. The down payment is yet to come as a gift from back home, right? Or
Mhm.
down payment is so. A mortgage approval is really based on just one number. It's the overall story that the lenders want to see, the overall package, which is why it's called a mortgage application. It's a package of everything together. It cannot
Right.
be just one single thing. Yes, there are products where if the client has 650 credit score, can they still get a mortgage from the bank? Yes, they can. If they have 630 credit score, can they get a mortgage from the bank? Yes, they can. If they have 550 credit score, can they get a mortgage from the bank? Yes, they can. Now the question arises is, what product would they qualify for? Which bank would qualify them? That is subject to adjudication and reviewing of the documents.
Obviously, interest and all this varies on depends on lender and what kind of package they're getting, basically, right?
Yeah, and in simple terms, I try to educate to clients as well sometimes. I said, think about yourself as a bank. If you were to lend to a person who does not have any stable income, right,
Right.
but has the best credit score, and you can't be sure about how they are going to meet their monthly obligations, would you be
Mhm.
very willing to lend them money? And
Exactly.
they said no. I said, and what if on the other side you have a client who has a perfect credit score with a good 2 year history that they have been making their obligations on time, have a perfect job, salaried income, they're buying a decent sized property, and they have the down payment to buy the property, right? And they have basically been on the position for a while. Would you give them a mortgage? Would you lend them a money? They said, yeah, we would. So it's same. It's just a common sense.
It's just a common sense, a very basic thing, actually. You're right.
Exactly.
So that is absolutely, you're absolutely correct, and that's what people, when they think about lending personal money to someone, you have to think about these little things as well. So bank is obviously thinking of securing their mortgage or
Yeah.
securing their fund.
Yeah.
Now, in your experience, because we've been doing this for a while now, so you in your experience as a first-time home buyer, what is the biggest mistake generally you see when they're preparing for a mortgage?
The biggest mistakes, Mr. Khan, I've seen people make is falling in love with the property even before they understand their own finances.
Mhm.
This is a case that we witness every day, and where we see people, get attached to properties of a certain dollar value when they can only afford the half of it, and then neither could they go ahead or they could fall back, and then they're in the middle. So this is very important. And also, I sometimes or many times have seen people who are also financially educated, who know what to do, have good income, have made a wise decision, spoken to a mortgage professional, but right before closing, they end up making some stupid mistakes. I'll tell you one of the scenarios. So I was working on a file, client's perfect income, $200,000, they were buying a property, decent sized property, they could afford it, they had another income coming up, so they could easily afford it. But one mistake that they did 2 days before closing was they ended up going to Ashley store and bought furniture for the new house with an expected delivery after closing. Now, as per them, they said the furniture is coming after the closing, how should that affect us? But they took a 0% financing from the store, that okay, fine, and that reflected on their bureau 1 day
So
before.
they actually, the lender actually checking the credit or
They could, they could, they
or
could,
they could. Okay.
they could,
It
and
could be very
sometimes if they
standard.
do, it
Yeah,
could jeopardize the whole deal.
I see. I see.
Luckily, in this case, we were saved because their income was too high as compared to what they were buying. But the lender still flagged the file because it was not reported to the lender.
I see. I see. So, what
Because
do you suggest for that? Like, I mean, obviously, people are when they're purchasing a new home, they're trying to set up their home. They're trying to buy some new furnitures. Of course, they're planning. So, what is a suggestion for those buyers when they're planning to do that?
before you make any such fancy decision, talk to your mortgage professional.
I see. Okay.
Keep them
Even after you
informed.
get the approval. Yeah.
Keep them informed. Before you are to
So
sign for anything, I even tell my clients, even if you're signing for a damn phone, talk to me before.
before you do any mistake like that. Yeah.
Exactly.
Absolutely, that's very important. So viewers, hopefully this is really helpful for if you're a new purchaser in the market or if you're looking to buy a house. These are the very, very crucial matters, actually. Sometimes we don't realize. We think, okay, you know what, I'm applying for a credit, but it can impact your total closing process, actually. It can actually, sometimes it can even fail your closing. So that's very careful about that. If you're dealing with a mortgage broker, always ask the questions before you make any mistake like that. And it's very important. Thank you for sharing that, Harvey Bhai. Next question that I want to ask you is, people, we talked about you want to make sure that they talk to the professional first, get the pre-assessment done, and do you prefer them to get pre-approved? And if so, what is the difference between this pre-qualified and pre-approval? If you can elaborate it for our viewers, please.
Yes. So pre-qualification is, as the name states, Mr. Khan, is a qualification that's basically before the actual review and the application submission. It's just a pre-qualification on the basis of information provided by the borrower. A pre-approval is where actual, your mortgage professional or a broker sits with you, does the mortgage application in the system, checks your GDS, TDS review, everything, and they might even in certain cases ask you for your income documents, credit documents, debts, or down payment, or any other documents that they might need. So pre-qualification is simply a verbal communication. It could be even by email, but that holds no substantial value. And nor does the pre-approval, because a pre-approval is via the broker itself who is working on the file. There might be something that was not disclosed to the broker in good faith or not in good faith, and that could jeopardize things. So I always insist the clients, whenever you're buying a property, it's very important to get a pre-approval done. But also, along with the pre-approval, the good thing is now we know what's our area or what's our field of play. The next thing to do is when you're putting up an offer, you put up an offer with a condition that's ideally between 5 to 7 business days. Usually, with any major lenders, it takes about 24 to 48 hours to get back the commitment. Once the commitment is received and we have the documents up front, we can send in the signed commitment along with the documents. And the banks do understand and respect the fact that the deal is under condition, and they can review all the documents upfront before we waive off the condition of financing. So the client is safe and sound, and the deal is safe and sound. So there are no surprises down the line, and the deal does not jeopardize, and nor does it affects clients in a negative way.
Right. But Harvey, you mentioned something about even pre-approval, all is not guaranteed once you even have that. Can you give us some scenarios for our viewers for this kind of situation? So when that can happen?
There are many, actually. Yes, I can give you one, and absolutely, because a pre-approval, as I said, is normally about the borrower, and it's not a final approval. It's about both the borrower and the property and the broker discussing it. They review the documents. Many cases, what happens is, Mr. Khan, we don't pull the bureaus. We don't pull the bureaus at pre-approvals, because pre-approval, usually the clients are looking to understand what they can afford. It has been cases where clients ended up taking another 2 months or 3 months, basically once before they settled on with the property that they want to buy. And when that is the case, we don't pull the bureaus, and sometimes clients don't tell us. Like there was one very recent scenario where a client was working. I was working on a client with a file, and the client told that the house is paid off. They said one of their properties is paid off, wherever that was not the case. It did not even come up on the bureau initially. But it was after we digged into it, we found out that there was a line of credit on the property. That client thought that he is paid off his mortgage and he's not using the line of credit, so that's not a mortgage. But that is not the case.
Gotcha.
A line of credit on the property, the banks do consider it as a liability. And if there is
the HELOC, you're talking about the HELOC, right? Is that the HELOC?
Yes, sir. So there are various products like from TD, from Scotia, where there's a HELOC component and a mortgage component. So as you keep paying your mortgage, your HELOC balance keeps increasing. So in that case, client had almost $360,000 of HELOC. So before knowing that, we were on the proper edge of the deal, like the GDS were on the proper edge. A single dollar could have made a difference. And now we have a surprise of $360,000 because the client failed to basically declare this to us. And there was no way for me to find it out unless we do a property search, which we don't usually do, because we are relying on the client's information provided. So those things can always happen.
That's very important. And I think it's very, very important to know about these things, because sometimes people think, okay, I have a pre-approval, I can go and purchase, but in the meantime, something happens in between that can affect the mortgage whole approval process, basically.
I'll tell you another funny thing as well. So client, not a funny thing, but it sounded like funny for the clients. So the clients, they got the pre-approval done. Again, as people they wanted to do max out, they're putting minimum down payment, fine, good. No any major debts, only $2,000 card limit, not used, whatever used being paid off. They go to Walmart, and the Walmart teller offers them that we have a special promo going on. Because you guys shop from Walmart all the time, if you take a Walmart MasterCard credit card, we would every shopping that you do, you would get about 2 to 3% in cash back. Client said that makes a good sense. Let's do it. Let's see how much can they approve for. So the client went ahead and they said, okay, how much limit do you want? They said $10,000. Let's see if we can get it. They got approved for $10,000. Everything went fine. When I did the application, it was $10,000. I said, why did this come into the play? This is the debt that is available to you. This might affect us. Oh, we were just, we went for a grocery shopping and there was a very fine lady who suggested us we take it and we took it.
Right. Right.
Changes the game.
The whole game changes.
Yeah, a lot of things happen like that. You know, uh, there was another scenario. So parents basically they own a house. They wanted to refinance because they were closing their builder purchase, and father didn't really remember. He signed up for his son's car, a fancy car, a Chevrolet Corvette, about 16 months back. He didn't remember that, and he thought that he's just a guarantor, and he's only basically he only has to make those payments, or it only gets added to his liability if his son does not make the payments. And the son was making payments. It was only until I told him that, sir, it's showing up on your bureau, and this will be accounted in your obligations.
So it's an equal obligation when somebody is like
Exactly, sir.
joint.
Exactly, sir. Exactly, sir. He
So
was the
that's
guarantor, and that was a $1,600 payment. That was
oh,
equivalent to $350,000 of eligibility. Boom,
absolutely.
gone.
It is very, very important. So viewers, as you can hear from Harvey, that these are very, see, sometimes we don't think about these little things. Even I heard, correct me if I'm wrong, Harvey, sometimes I heard that people are applying for a new cell phone.
Mhm.
That can sometimes affect as well, I heard. But little things, but you never think about it. But these little things actually can make a big impact to your whole process of mortgage approval. So be
100%.
careful about that. And when you're not sure about something, please do ask. I mean, there's people like Harvey is available. People like even realtors can help you answering a few
100%.
of those, basic questions. So if you're not sure, but don't take the attempt without asking, because once you've taken the attempt, then it could be too late sometimes. So be careful about that especially when you're buying for the very first time. So those are very helpful answers, Harvey. By the way, thank you so much. Now I want to ask you this: like, how does it impact when person has a car loan, like student loan, credit card debts, and to qualify for mortgage, their existing debts? How does it impact?
This surprises a lot of borrowers, Mr. Khan. That beautiful new vehicle or an old vehicle that you have, or a vintage car in your driveway, can sometimes cost you much more in mortgage qualification than people realize. Let us
Mm,
look at your total monthly debt obligations. I mean, relatively to your income, car payments, line of credits, credit cards, student loans, any other obligations can reduce how much you can basically qualify for. So if someone's buying or planning to buy a home in the 6 months, talk to us. Give us a call. Give us a call before taking a major new monthly payment or any other obligation, or even if you have one, talk to us. Before financing the car, find out what it could do to the financing of the house, or your future plannings that you want to do. There has been multiple cases. I had a client who was making decent enough income to buy a condo. He feels this is the best time to buy a condo because the condos are at all-time low. But unfortunately, the guy owns a Mercedes GLE with $2,000 of monthly payments.
that affect the overhead generally overall, of
It
course.
takes away everything from him.
So, Harvey, I want to ask you this. As we all know, that there's a stress test, obviously, for every single mortgage application. How does it impact for a regular, first-time home buyer? Um, is it making it harder a bit because of stress, but they can they still qualify with it?
Yeah. So I sometimes, and actually, when people ask me the same question, I tell them, I said, think of the stress test as a financial safety margin. You may receive one mortgage rate, but for qualification purposes, the lender generally has to test whether you could afford the mortgage at a higher qualifying rate. That's the whole idea. Why this is important? Because see what happened in 2022 and after.
Mm,
People who got mortgages at, Mr. Khan, 1.5%, 2%, 1%,
right.
right? And then the rates jumped to 5%, 6%. If those people would not have been stress tested, which means the banks would not have checked that if the payments would go higher, how would they qualify? Because at that time, The stress test was same as of now at 5.25%, or the contract rate plus 2. The contract rates were much cheaper at that time, but the stress test of 5.25% qualifying rate saved a lot of people because
Absolutely.
at that
But
time people wanted to go
yeah,
max.
right, right. What happens is even if it crosses that extra stress, if it passes the stress level, then what happens in the reality? I don't think it's going to happen like that. But let's say there's a 2% of stress you're putting on the people now,
It's
and
actually
it
happened.
it
It's
happened.
actually happened. It's actually happened during the 2022 to 2025 period, Mr. Khan.
Right,
So mortgages are not just being offered by the A lenders; they're also being offered by the alternate lenders, who also qualify the clients under the stress test. So I remember at that time, let's say ABC Bank, onto the alternate side, they were offering rates of as low as 2.5%, pretty much half of what the A banks are offering right now. But they were still qualifying the people at 5.25%. And usually their terms are either 1 year, 2 year, or 3 year. So let's say someone took a mortgage in 2022, and by the time 2024 came, now the new rates were much higher. And then they ended up, basically going for a 6% mortgage,
hmm
right? So they were safe for that very period, but that financial burden that came on them was much higher. But because it was stress tested, technically you see from 2% to 6% is technically three times, right? The payments went up so high. But
right,
because they were stress tested, they had that cushion. Okay, fine, and something goes bad, there is a cushion we have, and they could survive. Was it a very pleasant time for them? No, no, it wasn't. It wasn't. It was for nobody, and it can be for nobody. But yeah, stress test helped a lot of people. And so the eventually, I mean, the whole idea is basically is that the banks, they want to make sure that there is a cushion if things go up, not if things go out of the way, right? And the rates go up, can the client still afford it?
right, right. And
That's
few
it.
people are still facing the difficulty because of the whatever they had in 2021, 2022. Obviously,
And that's
absolutely.
not necessarily due to the rates. I would also say that's also in terms of, when you try to over leverage yourself, when you don't plan for your family budgets, when you don't see any unseeable expenses that could incur. People always think that no, this is fine, it's going to be like this forever. No, things change in a very quick way. Things change. Who expected Trump to be such a bully, when he came and he would try to basically knock down Canada in every angle? Nobody
Right,
expected that, right?
right.
So,
Uncertainty. Yeah, of course. Now, Harvey, what about we're dealing with regular home buyers who has a job or some kind of employment income. What happens to the self-employers? Somebody with very difficult to keep their accountability of income, or no control of that. They have different options to record their income. So how can we deal those kind of people to purchase their first home?
good question, Mr. Khan. So, this is where people need to understand that the Canadian mortgage market is much larger than one bank or the top six banks. Depending on the circumstances, there are prime lenders, alternative lenders, and private lending solutions. The real question is why the credit is weaker. We need to understand that. Or in some cases, why the income is like that. We need to understand that. So let's say someone has a self-employed income. He's not reporting that much to the CRA for whatsoever reasons, right? But he's actually making money. In that case, the alternate lenders, they come into play. They come into play as in saviors. But with all and any alternate lenders, you require 20% down payment. We can still evaluate what you make. It's more of, I would say, a more common sense approach in a simple layman language. So what the alternate lenders look is, they don't look at what you report to CRA. You might be reporting $35,000 or $50,000 to CRA because as a business owner, you incur expenses, right? Or your income is divided into your personal income and your business income, right? Whereas onto the alternate side, what they say is, okay, fine, we can look into your bank statements, show us your last 12 months bank statements. Let us look at the consistency of income. Let's say someone is a real estate broker, for example, and the person, their income is not very consistent. There might be good months you make a very good money, there might be 2 months that you don't make that kind of money, right? But if there is a consistency, and they see that in the last 12 months you've made this much of income, the alternate lenders take a more common sense approach, and they can qualify you for much higher than what a traditional or an A side bank would qualify you for. So even if your income is a more challenged scenario, or let's say your credit is a more challenged, let's say someone had a hardship, because of this Trump wars going on, and the credit score have gone down now. Let's say someone is around 550 or 580, but they do have down payment. They're still making money. They still want to buy the property. Can they? Yes, they can. Will the bank still give them a mortgage? Yes, the banks will, depending on various factors. Factors like, do they have the ability to service the mortgage? If yes, then the answer is yes.
So they're obviously they have to some kind of premium fees to pay for those kind of services.
100%, 100%, 100%.
Right.
And when it comes to basically rates, is yes, it might be a little bit higher, depending on. We also need to understand why we even need to go that pathway, right? Why are we doing that pathway? Because we have a challenge. A credit score is important, but it doesn't tell the entire story to the lenders. So once we narrate and explain the whole story to the lenders, that's when they have a more common sense approach, and they can make exceptions based on that fact.
Perfect. So what about that goes for the self-employed people, and what about the people that coming to this country, newcomers, and with a short Canadian credit history or no history at all, but sometimes they have money back home and they have the capacity to purchase. What happens to those kind of home buyers?
There are a lot of options, and there are many new to Canada programs, especially run by all these major three insurer companies and also by the banks. So let's say a short Canadian credit history. I mean, it doesn't really mean that someone cannot qualify. It depends on the lender and the program. We may look at employment, we may look at the down payment, we may look at the Canadian credit that has been established, or the international financial history, or any supporting documentation. For example, let's say someone's coming in from India. So in India, there is a thing called CIBIL score. Just like we have an Equifax score, they have a CIBIL score. There has been multiple files that I've done where basically the clients are newcomers. They came in here, they got the PR, right? They've been working for bigger companies like Infosys or any other IT company. What happens in those cases, they might not have built that credit because they're just here for 6 months, right? They landed as immigrants. So they landed as a PR. Now they want to buy a property because both husband and wife making great income. In those cases, we have got exceptions from the banks that we will provide them the Indian CIBIL report that shows their credit history in India, right? And basically stitch that up with the Canadian credit bureaus and show it as a presentable case to the lender. And we've got approvals many a times. And same way, there are credit reporting agencies in pretty much all the countries, I would say.
So their income can be accounted for too, like from international income, like their whatever the money there. Because sometimes people, let's say from India, Bangladesh, sometimes people has rental income consistently coming every month to their bank account. Can that be shown as a part of their income?
Not with prime or alternate lenders, but there are many MIC lenders who don't really care much about the income portion, or if there is a way that we could show them that income is coming in there, they would consider it. For A-side banks, what they would need to see is the borrower reporting that income in Canada as an income on their CRA documents.
I see.
So let's say someone has properties in Bangladesh and they want to buy a property up here. They don't have any other income, but they have a lot of rental income coming from Bangladesh, right? There's nothing wrong with it. The only thing that they have to do is they have to make sure they're reporting this income in Canada to CRA. And they're paying taxes on this. If they are not, then there are other products that we can look into and help them qualify for them.
But there's always a way to actually resolve this kind of buyers' concerns or issues they may have.
Yes, there are always ways to basically work it out on different products that we could help them qualify under.
So viewers, as you can hear from Harvey, that everyone has an option here. It could be prime six banks, or it could be secondary lenders, but there's options are available for every buyers. You just have to talk to a professional and figure out where you stand, and based on that, you have to figure out if you can purchase and get qualified for mortgage or not. So, Harvey, I will get to the next question that we have. Sometimes people have different type of down payment, 5%, 10%, 20%. So if you can let us know, does that impact the interest rate or the monthly payment? How exactly sometimes I've seen people has, obviously the more down payment gets you lower monthly payment, but the interest rate varies all the time. It depends on the down payment. So if you can tell that to our viewers, how that works exactly.
Yes, it does. Well, let's start with the very basic thing that's called insured mortgages in Canada, where you're putting less than 20% down payment. And usually the interest rates with these mortgages is the cheapest, because these are the insured mortgages that are backed also by the Canadian government. So if anything goes wrong, there are insurance companies who would back it and basically pay off the bank. So banks are at low risk, and because they're at low risk, they lend the money at much cheaper rates. The second category is the insurable category or the uninsurable category. In the third scenario, where you're putting 20% or more down payment, in those cases, they're not insured mortgages, right? They're either the bank takes an insurance on it, which is where they call the insurable mortgages, where the amortization is usually between 25 years or maybe in 30 in some cases. But in those cases, it's insurable. The rates could be a little higher from the insured mortgages, where you're putting less than 20%, but still a little bit cheaper than uninsurable mortgages. Now, what is uninsurable mortgages? It is usually, let's say someone's buying a property more than $1.5 million, right? And they're putting 20% down or even 30% down payment. These mortgages cannot be insured. So there are more risk to the lenders. And because it's of more risk to the lenders, there is a little bit of more rate premium. Now, is there a very major difference between these three categories? Not really. You would see insured mortgages in this date as of today about 3.5%. For insurable or even uninsurable mortgages, you can see rates around 3.79 or 3.65. So you see about 0.15 to 0.2 or maybe 0.3% difference, not any major difference.
Right. So, but in your expertise, what would you suggest if somebody has option for 20% or they have option to go lower? What would you suggest them at the beginning if they have both options?
So again, it's not just merely the down payment that affects the interest rate. It's the overall package, the amount that you're borrowing, your monthly payment, your loan to value ratio, and then potentially whether mortgage default insurance is required or not required in that specific deal. So generally, more down payment will basically only mean a smaller mortgage. But yeah, that's eventually the case. But if you put more down payment, you will automatically qualify for a lower rate. That will not be the case.
Okay, that makes it more. Yes, of course. So that's also again depend on the person to person what is best for them.
It's an overall package.
Right, it's an overall package.
All the 5 C's.
Absolutely. Thank you, Harvey. And now we know that we have all different type of mortgage, variable mortgage, fixed mortgage. If you can slightly tell us about this, all different terms, open mortgage, closed mortgage, because people are always confused about that, and they would like to hear from a professional like you. So what's the difference?
Let's start with the insured mortgage first. Then in that case, insured mortgages are basically mortgages that are insured by the 3 major insurance companies in Canada, which is the CMHC, Canada Guarantee, or Sagen. What these companies do is they insure the mortgage. They insure the mortgage just like you take a life insurance. So that insurance gives the banks the guarantee that if the borrower fails to make the monthly obligations or fails to pay the mortgage, the insurance company will pay the bank. Because the mortgage is insured, it is onto the most cheapest side when it comes to the rates, right? Second thing is insurable, just as we discussed. It basically, in those insured mortgages, there are 2 types of rates. One is the fixed rate, and then is the variable rate. Because these mortgages are insured, they are the most cheapest. The banks try to give them at the lowest offers because this is the best business for them. Then the second case comes is When it is not an insured mortgage, it's again a little bit higher rate. The fixed rates, they depend on how the bond market varies in the overall scenario, how the US bond, how the Canadian bond market fluctuates. And the variable rates, they are dependent on what the Bank of Canada decides in terms of prime rates. We usually hear every month, every couple months, that the Bank of Canada has either maintained the same Bank of Canada prime rate, or they have changed the Bank of Canada prime rate. So what is the Bank of Canada prime rate? It's basically the prime rate that which the Bank of Canada lends the money to the banks. And then the banks make a margin on it. So let's say as of today, if the Bank of Canada prime rate is 2.25, bank wants to make a margin of another 2% of an annual on that mortgage. So they would lend it out at, let's say, for example, 4% or 4.25 into the variable rate side. Now, the rates could vary depending on what mortgage you take, but the variable rates are totally based on what the Bank of Canada's prime rates are. The fixed rates, they depend on what the Canadian bond market rates are. They may be affected by the geopolitical events happening. As of today, when we have a lot of uncertainty going with the US, the bond markets have spiked a lot. You would be seeing insured mortgage rates in a mid 4% to high 4%, whereas with the variable rates, you would be seeing them in mid 3% rates. So that's a big difference as well.
That's a big difference. Now, thank you for clarifying this. It's always, people ask these questions, and it's always good to hear from a professional like you. Thank you, Harvey. And as we know that interest rates are changing over time, of course, and there's another announcement coming up, I think September first week. So we are always expecting that it should go low. It will be more helpful for buyers and borrowers. But for this time of all these changes that we're seeing, would you suggest most of the buyers to stay as a fixed rate or variable rate? What is your suggestion?
I would suggest review the overall application, your budgets, your long term and your short term goals, and then make a wise decision. Why this is important? Because let's say the renewal is for an investment property that the borrower might think to sell it down the line, maybe in a year or two. If they end up taking a fixed mortgage for 3 years or 5 years and they have to break it, the penalties could be substantial. Whereas if the client took a variable rate mortgage, now again, in variable also there are two scenarios. One, if the client is very certain, I'm going to sell the property within 1 year, I would recommend you take a 1 year variable open mortgage, which means the rates would be on a substantially higher price range, could be in 5 or 6%, depending on which bank you're with. But that will give you the freedom that you won't have to pay any penalties. But if you think you're going to stick with this house, maybe 2 years, maybe three, maybe four, you can even think of variable rates for a 3 year or a 5 year term. So a lot of factors come into play, sir. Whenever somebody is basically making a decision either on a renewal or a purchase, sit with your mortgage professional, talk to them about your long term, your short term goals, your family plans, and then make a decision accordingly. Don't just follow the pack. We have seen this a lot many times that people might have even heard of. And I've seen this with my own eyes. I've seen people making decisions just because their uncle told them and their aunt told them, who has no clue about how the financial market works.
Very
They just
commonly
took
done.
it, yeah, they just took it because their friend took it or their friend's brother took it. And they don't even know what that friend's brother does for a living and what their goals are. So don't make your decisions, friends, just because somebody is telling you. Talk to a professional. If you have a pain in your stomach, you go to the doctor. You don't ask your uncle and aunt these days, or just your neighbor. Well, for basic remedies they can tell you, but this is a financial obligation you're signing up for. Talk to a professional.
And it can affect for the long run. So obviously, every person has a different financial situation, so they have to discuss.
100%.
Yeah. As you know, viewers, this is very, very important. You don't make a decision based on what your friend did or your neighbor did or your uncle, and you have to make a decision based on your own financial situation. So that's why always talk to a financial advisor or mortgage broker before you make a decision like that. I want to move into a little bit of renewal side now. We talked about a lot about this basic things of the mortgage, Harvey. So for the renewal time, many people are approaching renewal this year, next year, because it will be started purchasing from 2022, 2021. And people always ask us as a realtor, what should we do? I always tell them, talk to your financial advisor before that. So what is your suggestion for the people who is approaching their renewal, and how do they start, and what to consider or not? So if you can talk in brief about that, that'll be greatly helpful for the viewers.
Thank you, Mr. Khan, for the question. We do get calls every day, and especially for people worried about the renewals, and when people are expecting much higher rates and everything. There is a lot of panic in the market as well with the viewers, with the borrowers. And I always tell people, shop, but don't overshop. There is a difference between shop and overshop. Overshop is when you are overworking onto something. See, if you're talking to a broker, stick to the broker. Understand what he's saying. Have a proper discussion. These are big obligations. Don't just rely on a phone call. Don't just think, okay, fine, what is the rate you could offer me? Sit with them, tell them what your long term, your short term goals are. I'll tell you one scenario that we recently witnessed, actually, a couple months back, Mr. Khan. Client, they had a mortgage with the bank, and at that time, this war, just basically the US-Iran war, it was about to start. And it was about 28th of February, I guess, 28, 29. And they called me. They said, I'm getting this rate from a bank. What is the rate you could offer? I said, are you only shopping for the rate, or are you shopping for the right product for you? They said, what is the difference? The lowest rate is the right product. I said, not necessarily. So unfortunately, what happened with that client is he was over shopping. He checked multiple aspects. Someone offered him a product that got him locked for another 3 years.
Wow.
Unfortunately, it was an investment property, Mr. Khan. He ended up losing the contract position that he was on. His tenants were not cooperating, so he had to end up listing that property last month. He received an offer on the property, lucky enough. When he received the offer, he initiated his lawyer to basically check with the lender what would be the payout statement. It was only until Mr. Khan he found out that the penalty was so huge because he took some cash back and the other benefits from the lender. He called me and he said, Harvey, you were right about something. You remember me? I said, sorry, I don't. He said, that's when I called you, and that's when you were offering me, you told me, check the product, not the rate. You're signing up for a product. He said, I did not. And things changed, unfortunately. And I had to, sell this property now, and I'm stuck now. What do I do? I said, there's nothing much I can do about it. You signed for it. You own it now. So these scenarios happen every day. When the lenders' renewals are coming up, usually all the lenders, they send you a renewal offer 90 days in advance. If you haven't received one, don't start 6 months, 8 months, 12 months before your renewal. That's over shopping. You don't need to do that. Wait. Unless there is a change in events, or you need any funds, you need to refinance it, or the rates that you currently have are too high, you want to switch it, and you're ready to take the penalty, or the lender might not be charging you a penalty if you were to switch a lender, then that's a different case. But wait for last 3 months. Once you get an offer from your lender, then give us a call. Let us know that this is the offer you're getting. Maybe we can just negotiate with the same lender for you and get you a lower rate, rather than switching you to another lender. Or maybe switching to another lender is a better option for you. But
so you talked about a very good point. I want to ask you this because when people are trying to renew, if somebody doesn't want to refinance and get some funds out, A lot of time people are afraid to get requalified again if they want to move it to a different lender. So what do you suggest for them if they're not looking for refinance and what their existing mortgage is offering with a competitive market rate? So do you suggest them to stay with that or still shop around a bit?
They can still call us and we can help them shop with the same lender itself.
I see. Okay.
It's been many a times.
But they still have to requalify, right? Requalification is required.
They don't have to do anything, sir. There is no requalification. There is nothing. It's just a simple renewal process. And we don't even charge any fee for that. Right. It's just a customer service. We guide you, we teach you, and you make your decision.
So it is very important. I have seen many people actually, as Mr. Harvey explained, that how one of his clients get affected by making a wrong decision with the wrong product. And I have seen it personally. Few people got into that as well. And that's why if you have a renewal coming up, or if your friends, family, anybody, getting close to a renewal time, please do talk to a mortgage specialist and mortgage broker before you make a, expensive mistake, because that can be really pricey if a mistake like that happens. Thank you for answering that, Harvey. We are really getting close to the time. We have 4 more minutes left. So I have a few more questions before we end this show. So next one I want to ask you, Harvey, is sometime I've seen people, they are actually focusing on interest rate more than the product, as you already talked about it, but because of their monthly income is pretty much, fixed income, they're having a salary, but they're focus on interest still just to keep it low. What do you tell those people? Still the product is important, as you mentioned, but they're still looking to minimize the interest rate. Can you tell them a good suggestion, like what to look for really with the fixed income they yearly get?
I'll tell you another story that also recently happened. So another client, again, another problem of, I want to go for the lowest rate, right? Husband and wife, they're on salaried position, Mr. Khan. Right. Salaried position means your income is going to be the same, right? It happened to them in 2022. They wanted to go for the lowest rate. They booked a rate of 0.99% at that time, whereas the fixed rates at that time for 5 years was 1.49, Mr. Khan. I told those clients, I remember my word by word. I said, guys, you have a consistent, a steady income. You're not self-employed. You don't have contracts, right? What if things go the other way? What if the rates spike up? Would you still be able to, to take care of all this? No, Harvey, we just want the lowest rate. My friend got that rate, 1.15. I want to get cheaper than that. You know why, Mr. Khan? Because people always think a low rate is when I win. That's not the case. Those lovely clients, they ended up losing their house, Mr. Khan.
Oh my God, that's really sad. Yeah.
Yes, because the rates went up till 5%. They couldn't afford it. Due to financial stress, they had basically conflicts between husband and wife. It eventually ended up into a divorce for them. Such a beautiful family, young, they had 1 kid, right? This is how the financial stress could impact you and your family. So was lowest rate the right decision for them? Maybe there could have been other reasons why things happened to them, but financial stress was one of the major reasons for them. Because we had many conversations even after with them, and even during the course of time, Mr. Khan, when they had opportunities to switch to a fixed rate, and I kept advising them, do it now. They said, no, my friend told us now the bank will not increase. My friend told us now the bank will not increase. And what does the friend do? He's into IT.
These are the common mistakes people are consistently making, I think. I agree with you.
It's very sad.
Very sad, very sad. Now, Harvey, thank you so much for your time. It's already 8 o'clock. And we can go all night actually asking question on mortgage. There's always endless question about this. Viewers, as you see, Mr. Harvey Dole, he's been working as a mortgage broker with Mortgage Architect, and he's really, really good. We have bring him to different programs and seminars we had, and he is very, very knowledgeable and very well, I would say, educator about the mortgage, because he talked to people all the time and figure out based on your unique situation. So if you ever have any questions, feel free to reach out to him. Mr. Harvey, if you don't mind, just to share your contact information, all this on the screen, but if you share a little bit from your all email and your phone number, that'll be helpful for some viewers.
Sure, I can. Do you want me to speak it over here?
Yes, please, if you don't mind.
Okay, so hello everyone. Again, my name is Harvey Dole. I'm a mortgage broker and I'm a team leader. I can be reached directly at my cell phone number. My cell phone number is 416-953-9800. And I can also be reached via email at Diol, Delta Echo Orange Love, that's my last name, at moneyplant.ca. Again, I can repeat my email. It's Diol, that's my last name, at moneyplant.ca.
Thank you so much, Harvey. And viewers, thank you so much for being with us for this entire time. And even though the show is going to end soon, but you can always throw your questions through email to Harvey, or even if you are inboxing us, we can pass that question to Mr. Harvey for no problem at all. And thank you again. Thank you so much, Harvey, for being with us tonight. We really appreciate it. You're a busy man. I know you're always a busy man. So thank you so much for sparing this time for us and our viewers. And I'm sure this will be helpful for many, many people. Thank you so much again, viewers. See you next week. As we know, every week we have a different professional coming to this show. Next week, we'll have another professional to answer your questions. Until then, have a great night. Have a good evening. Take care of yourself. Take care, Harvey. Bye-bye.
Thank you, guys. Thank you. Bye-bye.